So welcome to the next part of our forecast. And now we're going to turn to commercial real estate and talk about the latest results from the Allen Matkins UCLA Anderson Forecast California Commercial Real Estate Survey. And we're welcoming back John Tipton. Many of you know John. John is a partner with Allen Matkins, and he and I have partnered in spearheading this survey for the last 15 years. John was educated at University of Miami and as a JD from Harvard, specializes in complex business transactions with an emphasis on real estate. And welcome back to UCLA, John.
Jerry, thank you very much. And just because I am a loyal Miami University alumni, I will correct you on that. University of Miami is a wonderful school as well, though, in Coral Gables. But I'm from Ohio, my school.
Oh.
But thank you.
Also an excellent institution.
Yes, indeed. So Jerry was really interested, obviously, to see the survey results. I mean, they were taken in fairness in the middle of a pandemic. You recently did a retrospective of how predictive the survey has been over time. And of course, there was a real precipitous drop across all four of the types of real estate that we survey. And I was wondering your thought in looking at the data, how much of that is that, well, this is the pandemic pushing us over the cliff, and how much of that is like, well, you got to look past the immediate results a little bit? What was your interpretation?
Well, I think it's the latter. And the reason is that this recession is really different than the other recessions that we've seen, certainly in our lifetime. Those other recessions involved an excess of production of houses, or maybe it's infrastructure or computers or defense goods. And so we had enough of those goods, and there was a pullback in demand. And there was a pullback in demand on the part of government or business or households. In this case, the pullback of demand that created the recession was to manage a healthcare crisis. And while pandemics are not new to human history, we don't have real good economic data on them, as you know, in terms of how they play out in a recession. But it's a very different recession. And so one of the things that we've done with this survey through the years is asked a whole multitude of questions, and we usually simply represent the survey with the summary results, the sentiment. In this case, we need to look behind that, and I think you'll find some of the results are really quite interesting. In the early 20th century, the economist A.C. Bagu made a statement. He studied the psychology of business during the business cycle, and he said at the end of an expansion, the era of optimism gives rise to the era of pessimism, which is born not a baby, but a giant. And I think we really see that in this survey.
So Jerry, one of the things in the survey is that we were obviously late in the cycle in a lot of the areas. How much are you seeing that that's being impacted by the pandemic, or how much is this, the survey results you're seeing, somewhat of a blip, and it seems like it's consistent with the general trends that we were seeing on a more long-term basis already?
Interestingly, it's mostly consistent with the general trends. And I mean, let's talk about office, and let me show you a couple of things on that we found in the survey in the office space. And of course, when we took this survey, we were all working at home, as we're doing right now. And there's a lot of talk about, oh, we're learning how to work at home. There's not going to be much demand for office space. That's a part of commercial real estate that's going to implode. So let me go to a couple of slides. I'm going to share my screen here for the moment. And we'll go back and forth to these slides. But this represents the results of a number of surveys from June of 2016 to June of 2020, and on the 6 markets that we surveyed for office space. And the dashed line there is at 50. Above 50 indicates that the sentiment is positive, that our panelists think that the market is going to improve, and below 50 that they think the market is going to be a little worse, and that is looking 3 years ahead.
Right.
So you see that in recently it's been kind of bouncing around that dashed line, and indicating that kind of on balance, our panelists think that the supply that's being created is going to just about meet the demand, right?
Right.
And sometimes that the supply is not enough, sometimes the supply is a little much, but on balance, supply and demand are kind of equalizing as we go forward through the expansion. And if you look at the last block on each of these, from San Francisco on the left-hand side to San Diego on the right, what you see is it just falls off a cliff in terms of sentiment. Very pessimistic. Markets are going to be really bad 3 years from now relative to today. And today is May 2020. That was when the survey was taken. So looking behind that, and this is where I come back to this era of pessimism born a giant, we also ask our panelists, what are you going to do in the next year? Are you going to build one new project, start one new project? So these are not continuing projects, but start one new project or start more than one. And what you see in this graph here is from 2016 to 2020, so the same period of time. And it's the June survey, which is the mid-year survey. So that's to take out any seasonality that might happen at the end of the year. We also do a December survey. But as you look at this, in 2016, it was a little over 35%, and then a little over 35%. Then it drops to about 32%, then goes up to 40%. In this survey, it's 35+%. It's the same. It's very normal. So even though there's a lot of discussion about the implosion of the demand for office space, our panelists think that 3 years from now, office space is going to be doing just fine. So they are pessimistic. Who isn't at this point in time? In terms of their actions, they're really looking for office markets to continue in kind of a balanced way of supply and demand being about the same as they are. And that means that even though rents may be going down, the cost of building is also going down, and returns are still satisfactory for building.
Well, I will tell you, as an office worker who for decades has felt that he spent too much time in the office building and was initially like, hey, working from home. It'll be technologically hard, but it'll be nice. The technology has actually gone far better than I'd hoped. I don't think how much I realized I missed the human interaction of being in an office place and the collaborativeness. So definitely, it's been an eye-opening experience for me, certainly.
I think that's certainly part of it, and I would agree with you. We at UCLA all miss being on campus, and that interaction is, I think, also the case that we all know how to work together because we've worked together in the office. We understand each other. We all understand our culture, but over time, firms and organizations add people leave, and how do you get acculturated to the organization? Only kind of by being there. You don't have to be there every day.
Right.
But kind of on the other hand, you certainly don't want to be there using a hot desk, right? That somebody else that you don't know just vacated. So that'll be a selling point to get the better employees, that you have a safer environment in terms of the way it's cleaned and that it's private.
So let's talk about retail. Retail, a couple of surveys ago, 2 surveys ago, it had an unsuspected bright spot, had more returned to the norm 6 months ago. And it seems like perhaps the news just keeps getting worse. Obviously we were already kind of in a economic structural readjustment, as it were, and then a complete loss of demand, bankruptcies rising. Do people see themselves doing any kind of retail projects going forward, and what do the panelists say?
Sure, and when we talk about retail, I think there's an important point. We're not talking about the purchase of goods. We're talking about the brick and mortar purchase of goods. So it's physical space. So let's just take a look at the retail. And if we can just go one forward. So if you look at the trend, this continues the trend, but it really exponentially declined. And this we were expecting. You know, in California, the number of workers in the retail sector during the expansion declined by 35,000. So we knew that retail was in trouble. And this is a sector that we're really not expecting to recover. There will be opportunities in retail. They'll be in multi-use buildings. They'll be in new housing developments. But overall, retail is overbuilt in California and in the US. A recent study that I just saw was on the amount of square footage per capita in the United States relative to other countries. The closest to the US is Canada at about 2/3 of the US. And in Europe, it's about 1/5. So we have seen an expansion of brick and mortar retail that is kind of beyond what the future economy, where online purchases can be substituted for brick and mortar retail, are going to be prevalent, and we're going to see a lot of unfortunately empty retail space that's going to be converted and repurposed.
So let me go to what has been the brightest spot in our survey, industrial. Obviously, every sector was hit hard. I'm curious to see how that sector, and maybe the opposite of the contraction for retail, people having to stay home, would be a boon for warehousing and distribution. And what did our panelists see in industrial?
So you would think that they would be really optimistic, seeing that everyone is ordering online. And again, we see, you know, Pagu's error of pessimism. So let's just take a look at that. And just kind of page forward. And we get, with the exception of the East Bay, where the view of our panel there was that industrial space was going to be good as good as it is today, which is actually pretty good. We see in Sacramento and San Joaquin County and Los Angeles, Orange County, Inland Empire, our panelists have all turned pessimistic about retail, about industrial rather. But let's look at what they said when we go a little bit deeper. So this is Southern California, where we saw all that pessimism. And this is the demand supply growth proportion. And so the dashed line at 50, above 50, is a view on the part of the panelists that demand is going to grow faster than supply. Well, it's been kind of a downward trend, and that's because there's been a lot of industrial building going on. But it's still the case that our panelists today feel that demand is going to grow more rapidly than supply. And, you know, part of that downward trend is not the move to online purchases, but the trade war that we've been having with China. You know, nevertheless, retail, industrial looks like this is going to be and continue to be a hot market as we grow out of this recession. And 3 years hence, the market will be at least as good as today.
Well, I think, you know, in fairness, surveys are taken by humans. And when you take a survey in the middle of a pandemic with tremendous uncertainty, even though you are projecting 3 years out, it's a little hard for that not to have some impact, and perhaps it should. Thinking about our last type of real estate, multifamily, which perhaps through our last 6-7 years has not been quite the ace card that industrial has been, certainly hasn't had the struggles of retail. It's been somewhere with office, maybe a little stronger. People still need a place to live, even if they can't go shopping. How did our panelists feel this time?
Sure, and let's turn to that. But you know, I want to react to a point that you just made. You know, when we ask our panelists about what do you think about the markets 3 years hence, Of course, they're going to be pessimistic, as you say. You know, you just can't ignore what's going on, kind of more generally. But when it comes to the specific things that they're looking at, what they're saying is, yes, I'm pessimistic, but here are some things that I found that actually really work for me. And so I'm going to go ahead and develop, because I think in that niche, in that market that I'm in, things are going to be fine.
Right.
And as you aggregate that over time and look behind these sentiment, the sentiment part of the survey, you see that there's a lot more optimism in the commercial real estate space than kind of the initial blush would tell you. So let's take a look at multifamily. And got a couple of slides on multifamily because we're sort of looking at the same kind of phenomenon, but there's something interesting has happened here. So on the left-hand side is San Francisco, Silicon Valley, and the East Bay. And that was below the 50 line. Now the 50 line is kind of bumped up there a little bit. So in your mind, push it down because it's above actually 50. But in the Bay Area, there was a fair amount of pessimism, and we attributed that pessimism to real concern in the multifamily market about rent control and what it was going to look like.
Right.
And after the state passed a rent control bill, our speculation was that sentiment in the Bay Area would look like sentiment in Southern California. Everyone is more pessimistic, but sentiment in the Bay Area looks like sentiment in Southern California. So there's been that convergence that we expected once the rent control issue was resolved. Now, of course, there are issues about moratoria on paying rent and new restrictions on landlords. That's a lot of uncertainty, and that gives us that pessimism. But the next slide will show you something interesting here. So this is, again, the percentage of the panelists who are planning new development in multifamily housing in the next 12 months. This covers all 6 markets, Northern California and Southern California. And it's, again, the June survey. And this is 2013 to 2020. If you look on the right-hand side of 2020, it's above 60%.
Right.
And it's higher than it was in 2019, lower than 2017 and 18, but higher than 2016.
Very surprising.
It looks really normal. So, kind of why is that? I think the answer is what you said sort of right at the beginning. People need a place to live. Housing in California is not overbuilt. Rents are soft in the Bay Area now. We're still trying to kind of figure that out. We think that some of these may be pied-à-terre of folks who were living kind of far afield in Bend or Tahoe or somewhere, and they would live during the week in the city of San Francisco, who, since they're now working at home, they have given up their apartments, so that may be part of it. Or it may be folks who are laid off and have moved in with others to conserve
Right.
resources.
Right.
But I don't think anyone would say that the Bay Area is overbuilt in housing,
No.
and that rents are not going to recover over the next 3 years. And this similarly in Southern California. And just the behavior of our developer panelists seems to indicate that that's what they believe also. They see opportunities to build multifamily housing because California, quite frankly, in the next 3, 4, maybe 10 years, California housing is not going to be that affordable. And that means superior returns to building. And the other aspect of this that I think is really important is that because of this recession and the depth of this recession, there are properties going on the market at a discount. And building costs have gone down and labor costs have gone down. And so even if your rents are somewhat muted and you're not getting those rent increases, if your costs are going down, your returns are going up.
Sure.
And so I think that's kind of, what the survey is showing. Now, you interact with your clients all the time. I'm sure they're nervous about regulatory issues, but in other regards, are you seeing them showing at least some optimism about the coming expansion?
Well, on the office side, are you talking office or strictly multifamily?
Any of the spaces that we've been talking about.
I think most of our clients have been, relatively surprised at people honoring their obligations. I mean, there's some obviously more in the mom and pop retail that just can't, and that's not a surprise to anyone. Certainly, there's been a lot of watching some of the actions in Sacramento, and particularly as far as potentially legislative changes for tenants being able to, in some cases, just say, yeah, I hereby terminate the lease. That was Senate Bill 939, which is ongoing. So there's definitely concern on that. But as far as kind of so far, on average, tenants and landlords honoring their obligations, I'd say it's been better than I think a lot of people would expect it. Having said that, most people are still getting PPP money. And so we'll see where kind of that interplay between that running out. Will Congress renew that? Can things reopen? Is there a second wave? Can we get a vaccine? To be seen.
There's a lot of uncertainty. Well, interestingly, in Sacramento, there's now a bill which is actually getting some traction. It went out of committee unanimously. Both Republicans and Democrats supported it, which would provide subsidies for owners of retail space to repurpose that for housing. Now, it has to be affordable, and meet certain criteria, but that would certainly be a benefit to those who own particularly strip malls with a lot of mom and pop retail that be making it. So
I have not followed that, but I agree.
Yeah, so they're in spite of the uniformly negative sentiment in this survey, which we expected, there are a lot of bright spots. And I think part of the reason is that this survey is not what is going on now, but what is going to go on 3 years from now in 2023.
Right.
And across these spaces, with the exception of retail, across these spaces, there is certainly some optimism about opportunities that may exist.
Right. Well, good. Well, overall, as you say, I mean, although not surprising that people were more pessimistic, perhaps not as bad as I thought. Some silver linings, and certainly I'll look forward to seeing where things are in November, December, when we survey again, and we'll certainly root for the optimistic outcome.
Yes, that will be an interesting survey because that will be very telling when it comes to the development of new space. It'll be, about 8 months into 8 months since the last peak.
Right.
And we'll know a lot more about the pandemic and about whether or not the opening up is, really happening in a big way.
Exactly.
Well, John, thank you for joining us, and welcome back to UCLA. And we look forward to seeing you in the very near future.
Jerry, it's a great pleasure, and Allen Matkins sure enjoys our ongoing partnership with the Anderson Forecast. Have a good day.
Thank you. You too.